This is question number 6 on homework 4. Green Manufacturing plans to announce that it will issue $2 million of perpetual debt, use the proceeds to repurchase common stock. So this is a classical example of changing the capital structure. The bonds will sell at par with a 5% annual coupon rate. So before we read down, why don't we try to put the information down to Excel as we read the setup. So this probably can save some time. So let's look at whether all the numbers are in millions. If so, then we can probably, okay, so if you look at the rounding requirement, round your answers to the nearest dollar, so we still need to work with the dollar. So let's just put everything in dollar terms rather than million dollar terms. So let me add a dollar sign here. So the B stands for the debt, right? B here is the debt. So the debt, perpetual debt is $2 million. And the bonds were sold at par with a 5% coupon rate. So coupon rate is 5%. And the price is the same as the par value, right? So that's what basically it tells us. So the price sale at par, which the par value is right here. Green is currently an all equity firm worth $11 million with 700,000 shares of common stock outstanding. So this sentence tells us that VU, right, unlevered firm value equals 11 million dollars. Yeah, so and the shares outstanding is 700,000. So obviously from these two numbers we can tell the price per share for the unlevered firm. After the sale of the bonds, Green will maintain the new capital structure indefinitely. Green currently generates annual pre-tax earnings of $2 million. So pre-tax earnings is $2 million. And the level of the earnings is expected to remain constant in perpetuity. So this is a perpetual. Perpetuity. Right? This is a perpetuity. We can use the present value of the perpetuity later to calculate the present value. This level of earnings at Green is subject to a corporate tax rate of 31%. So tax rate is 31%. Unless otherwise noted, round your answers to two decimal places. So A, the expected return on Green's market value of equity before the announcement of the debt issue is, so before the announcement of the debt issue, the firm is all equity financed. So it's unlevered. And we know the total firm value, right, $11 million. And to get the return, so that's basically the, so it's the return on the market value of equity. Remember, this is not, so to calculate this return, we don't actually go to the balance sheet, right? Because balance sheet tells us the book value of the equity. Here, the denominator should be the market value of equity, which is $11 million. So the numerator, which basically should be the after-tax earnings, right? So that's what the shareholders get each period. Hence, return on equity, market value based. Let me just note this as a market value based. This should be the after tax, so it's a pre-tax earnings multiplied by 1 minus the tax rate, right? So this is after tax earnings and divided by the total equity value before the issuance of the debt, which is the unlevered firm value. So this gives me So let me put this as in percentage term, and I guess we need to keep two decimal places, right? Unless otherwise noted, we need to keep that, and this is in percentage, so it's 12.55. So part B, construct Green's market value balance sheet. So normally balance sheet is book value based. So this is ask us to construct market value based balance sheet before the announcement of the debt issue. So before the announcement of the debt issue, there's no debt, right? So on the right hand side, the debt should be zero, and equity. Remember, as we said, this is for the market value based balance sheet. So we cannot write the book value of the equity here. So the market value of equity obviously is $11 million, right? So that's I think we have been told about that $11 million. Hence, the total should also be $11 million total D&D, D&E, debt and equity, right? So the balance, these assets also need to be the same. So that's the balance sheet identity, right? So that's the total assets right here. And the price per share of the firm's equity, as we said, this is easy to do. So just put this price per share should be VU divided by shares outstanding, right? So this gives us, keep two decimal places, give us 15.71, 15.71, okay? So part C, construct Green's market value balance sheet immediately after the announcement of the debt issue. So this part of the question will ask us our knowledge about market efficiency, right? Because when we talk about market efficiency, we say that market efficiency means that the price will adjust to the information quickly and fully. So here the new information is the issuance of the debt, right? So we know that with the M&M, Modigliani, and Miner Proposition I with taxes, if we go back to our slides, right, with the issuance of debt, because VL equals VU plus TC times B, right? When B becomes positive, firm value, which is levered firm value now, should go up relative to the unlevered firm value. So the rise of the firm value actually goes to the shareholders, because the debt holders, they don't enjoy and the reason why we have the increase of the firm value after the issuance of the debt because interest payment is tax deductible, right? So when the firm pays interest, it can save taxes, and that saving goes to the shareholders rather than to the creditors, right? So that's basically the sort of the fundamental idea behind this. So eventually, the total firm value will go up by this tax shield, right? This is called the tax shield of debt, TC times B. Hence, the total assets, we are talking about market value based assets, right? So the total assets, which is also the total firm value, will go up. So that's the left hand side of the balance sheet, right? That will go up. And right hand side, as we said, the debt hasn't been issued yet. So the debt will still be zero. Right? When the firm makes an announcement, no debt has been issued. So B should still be zero. But to balance the balance sheet, the equity has to go up by the same amount as the firm value. Right? So that's basically the idea behind this question. Right? So the old assets, if you look at this format of this balance sheet, the old asset, it should be 11 million, right? The tax shield should be, let's go back to our, so the tax shield, right? This is basically B times TC. So we can just plug in the numbers. B is right here, $2 million, and TC is tax rate is 31%. So this gives us a $620,000. So let's just put that back. $620,000. As we said, after this announcement, before the actual issuance of the debt is still zero. So if you sum up the total assets, what do you have? You have this, so the total assets, let's put this right here, should be the initial asset, which is the unlevered fair value, plus this tax shield. All right, so this is the total assets. So this is the $11,620,000. So let's put that back. And to balance the balance sheet, equity has to be the same. $11 million, $620,000. So that's basically what this is. So the total is $11,620,000. Right, so D, Green's stock price per share immediately after the repurchase announcement is. So now the equity has been going up relative to the previous level, right? Once 11,620,000 versus 11 million. And no shares have been actually bought back yet because the firm intends to use the receipt from the issuance of the debt to buy back some of its own shares. But here, no debt has been issued yet. So, but because of this arrival of the new information, equity value or the market value of the equity, which is the stock price, will adjust upward immediately. So then the question part D here is basically asking us what is the new stock price, right? So again, we have to have some knowledge of the market efficiency in order to answer this question, right? So how can we get the stock price per share? We know the total equity value, right, which is $11,620,000. So to get the new stock price, right, we just need to divide this, right? The total assets, which is also the total equity, because no debt has been issued yet. And we just need to divide that by the shares outstanding. And because no shares has been bought back yet, so the shares outstanding is still the old shares outstanding. So this gives us, let's keep both decimal places, right? It doesn't matter here. So it's, I keep going to the other. So it's 16.60. Right, so if you compare this number with the previous number, right? Previously we have 15.71, but now the price has been going up as expected. Part E, Green will purchase how many shares as a result of the debt issue, right? We know the total receipt from the debt issue, which is $2 million. We know the total, the new stock price. So the firm can no longer purchase the shares at the old price of $15.71, right? Because the price will immediately adjust upward. And we know the total amount of the money that the firm will use to buy back its shares. So how many shares? How many shares? Number of shares to be bought back. This should be simply be $2 million divided by the new stock price per share. All right, so that's the total number of shares outstanding. We don't need the currency here, and we just need to keep two decimal places. So this is the, just copy the number back. We purchase how many shares. So this fractional number of shares doesn't matter. Yeah, even though in reality this may not happen, but we just put this number as required because we need to keep two decimal places. And hence, how many shares are remaining after the repurchase of this much of the shares? Remaining shares outstanding, right? So that's basically how many? So it's 700,000 minus this 12481.793, right? So this gives us, again, I don't need this currency, just need this normal number. So this is the total number of shares remaining after the repurchase. Now, part F, construct the market value balance sheet after the restructuring. Round your answers to the nearest dollar. So this is rounding my answers to the nearest dollar. Actually, for this, yeah, for the part C, it's the same requirement. So now, after the issuance of debt, debt obviously will be $2 million, right? So that's very easy to do. Just fill on the right-hand side of the balance sheet first. And equity, because the debt will be used to displace a portion of the equity. So with the addition of the debt, equity will decrease by the same amount, basically, right? So it's going to be $11,620,000 minus this $2 million. $2 million. So that is the remaining equity. Or you can also, how can we get how can we use? So let me first write down the first way. Okay, so it's going to be 11,620,000 minus this 2 million, right? This 2 million total debt. That gives us the remaining equity. And another way to get the same answer, second way, okay? So that's going to be stock price per share, new stock price per share multiplied by the remaining shares outstanding. All right, so you can see these two ways will give us exactly the same answer. Otherwise, you can see somewhere might be have some issues. So it's $9,620,000 dollars, right? So it's $9,620,000 dollars. And the total will still be the same, $11,620,000 dollars. Again, the left-hand side, I don't think it changes, right, relative to this. So we can just copy these numbers. Old assets with still the unlevered fair value, but now with the tax yield, we can sum up these two to get the total fair value, which we can copy from the right because it's based on the balance sheet identity, right? So we just copy that number, $11,620,000. So the final part G, the required return on Green's equity after the restructuring is. So the required return, we know the remaining market value of the equity, right? And the earnings do not change, right? The earnings, the pre-tax earnings do not change. Let's put that way, the EBIT, right? So this should be understood as the EBIT now. So let's put that way. So this is like the EBIT. And in the first case, EBIT under unlevered capital structure, which means that the firm doesn't have any leverage or debt, should also be EBT, which is earnings before taxes, right? Because there's no I part, which is the interest part. So, but now there will be some difference because the interest payment, interest expense can be calculated. Right? How can we calculate the interest expense? It's going to be the total amount of the debt and then multiplied by the coupon rate. Why can't I just multiply by the coupon rate? Because it says it issues at par. So coupon rate, if a bond is traded at par, it also means its interest rate, which is the yield of maturity, yield to maturity, should also be equal to the coupon rate. Right? So the coupon rate here should be the interest rate. So just multiply by the interest rate, and I guess it states it's an annually coupon bond, right? Annual coupon bond. So this is the annual interest rate, interest expense. So now EBIT does not change, right? So from this we can calculate EBT. So EBT is going to be EBIT, it's right here, minus this interest expense. And from EBT, I can get the taxes, and so the taxes will be EBT multiplied by the tax rate. My tax rate is 31%. And now if I deduct the taxes from EBT, then I arrive at net income, right? So that's basically a typical capital income statement. So it's going to be EBT minus this taxes. So that's basically will serve as my numerator, right? Because if you define, if you calculate ROE, return on equity, what you need on the numerator is net income that will go to the shareholders, right? That's the net income, and the denominator will be the equity. But again, this is the market value based return on equity, so we need to use the market value of the equity instead of the book value of the equity as the denominator. So the return on equity new should be net income divided by the remaining equity, right? And you can see that. So this is one way we can get the answer. Okay, I'm gonna also use another way, which we will use the M&M Proposition II to figure out the same answer. So at least now we know one way we can get that answer. And let's use the second way now. So let me first put down this as the final answer. And using the second way, we can double check whether we arrive at the same answer. Okay, so to use the second way, I'm gonna count on this proposition 2, which is the levered return on equity, right? This RS basically is the return on equity, but under debt, equals unlevered return on equity, right? This is a R0, which is also called return on asset, because when there's no leverage, then asset equals equity. And plus B over S times 1 minus TC times R0 minus RB. So RB, as we said, coupon rate is RB, right? Because the bond is traded at par. And B over S, what is B over S? Let's calculate B over S. Right? B over S should be 2 million divided by remaining equity, right? Remaining equity, that's the S. So this gives me the B over S, and so now I can plug. I basically have everything available, right? R0 is calculated before. That's like the first. Based on the first part of this question is asking us what is the ROE, right, before the issuance of debt. That's basically R0. That's the market value, that's the return on this. That's R0, 12.55%, right? So we can just, so now RS should equal to 12.55%. So that's basically just plugging this as R0 now, plus B over S, plus B over S. Right, B over S is right here. And multiply by 1 minus the tax rate. 1 minus the tax rate. So tax rate is right here. And then continue to multiply by R0 minus RB. Right? R0 is, again, it's this 12.55%. And minus RB. RB is 5%. So now I can close this, and you can see once I reduce the number of decimal places, I got exactly the same answer as what I got here, which I will mark both in yellow. So you see that I got the same answer. So this is new. So 13.63%. So this gives us further confidence in our work. So check my work now and see whether I got the correct answers. There's one. Oh, I guess this is a typo. That's why we have to be super careful. So it's 11,620. I added one additional one. So that's why I got the typo here. But all other answers, I believe, are correct. This is a typo, which means I should double check my answer before I submit. So let me get rid of this and check my work again. So now I should have everything correct. Great.